Hello, my name is Nadia Soroyan, and I'm going to be doing the ratio analysis for Avon. So when calculating the ratios for this project, I had a difficult time finding anything really relevant for any of Avon's competitors because none of the competitors were public, therefore the financials were not open to the public. The information I did find was from each company's website or from 3 years prior. For activity ratios, I didn't find much information on any company other than L'Oreal. And for the profitability ratio, I didn't find anything on the competitors throughout the years. So here are the liquidity ratios for Mary Kay, Unique, Tyra, and Avon. The current ratio and the quick ratio were the ones that I calculated. And I pulled all this off of the website. Now, this information, current assets, current liabilities, and inventory were things that I did find on these companies' website, but there wasn't much more. A lot of the company's information would say NA or just be blank. So for the liquidity ratio, it's a company's ability to pay both short-term and long-term obligations by measuring liquidity. And for Mary Kay and Unique, they were very bad, and for Tyra and Avon, they were actually quite good. The ratio cannot be below 1, and as you can see for Tyra and Avon, they were above 1, and it was not the same for Unique and Mary Kay. It was 0.19 and 0.6. Those are really bad current ratios. Okay, so quick ratio 1 means if the company fails today, is it liquid enough to cover its liabilities? And some of the current assets are cash, marketable securities, and accounts receivable, and that's what's used to calculate the liquidity. So while Tyra and Avon sat right under 1, the other two companies did very poorly. The closer to 1 a company is, the more successful it is. As you can see for Tyra and Avon, they were almost to 1. Tyra was 0.99. That is a really good quick ratio. Mary Kay and Unique were very bad. So for the leveraging ratios, Mary Kay was probably the worst, and Unique and Tyra were around the middle, and Avon was about as bad as Mary Kay. So the equity numbers on these companies were all bad. None of them were public, but they still have some equity. The only one that comes close to having a normal LTDE ratio is Avon, and that's still pretty bad. Mary Kay is currently in the negatives. Unique has the largest long-term debt to equity ratio, and Avon is the most debt at 24 million. That is a lot of debt. So for the activity ratios, we looked at inventory ratio and asset ratio. Those are the best determinants of the activity in a company. So for inventory ratio or inventory turnover, it's a measure of the number of times inventory is sold or used in a time period, and they are usually compared to the industry averages. Asset turnover is a measure, it measures the efficiency of a company's use of its assets in generating sales revenue or sales income to the company. There's no set number for an asset turnover ratio, but companies with lower profit margins tend to have high asset turnover, and that's exactly the opposite for companies with high profit margins. So for Revlon, the company, as you can see here, inventory turnover ratio, it is higher than Avon's inventory turnover ratio. And for the asset turnover ratio, it is higher as well, or excuse me, it is lower as well. And I'm going to talk about that in a minute. So since Revlon's asset turnover ratio is smaller than Avon's, you can see that it has a higher profit margin. Since Revlon's inventory turnover ratio is larger than Avon's, it shows that it has a harder time selling its products than Avon. This could just be because it actually has storefronts. So for profitability ratios, we looked at asset turnover, and these are the last 3 years. And then for return on asset ratio, and then return on equity ratio. And it's astounding that for Avon, the company had a negative 55.52. So for profitability ratio, as you can see, asset turnover got larger throughout the years, meaning Avon isn't selling as much as fast anymore. So the return on assets has grown worse, and when calculated for 2015, it ended up being negative 24.51, whereas in 2014 it was 6.48. That's almost an 18 number jump. So the return on equity was very bad for 2014. It was a negative 55. All of these ratios for Avon and its competitors signify a decrease in the direct selling market. Thank you for listening.